The topic for this webinar is alphabet soup for installment agreements. This is just a little bit about me. I'm a trial lawyer as well as an actor and author and marathon runner. So let's jump right into today's webinar. Let's begin by basically asking the question, answering the question, what is an installment agreement? An installment agreement is an option for taxpayers who cannot pay their entire tax bills by the due date. It allows taxpayers to pay the amount due over a period of time. Now, once the taxpayer is granted an installment agreement, the agreement remains in effect as long as the taxpayer meets the terms of the agreement. And the operative phrase there is as long as the taxpayer meets the terms of the agreement. Just because the IRS approves an installment agreement doesn't mean that the taxpayer is out of the woods, so to speak. The taxpayer still has the sword of Damocles hanging over his or her head, in the sense that the IRS could potentially terminate the installment agreement if the taxpayer fails to satisfy the terms of the agreement. If the taxpayer stops making required payments, he or she will be notified that the installment agreement will be terminated. This is part of the due process rights that the IRS affords the taxpayer. There are times when collections may reject a taxpayer's request for an installment agreement if collections believes that it does not accurately reflect the taxpayer's ability to pay his or her tax liability. Okay, so backing up into this, whenever a taxpayer requests an installment agreement, there is a bunch of paperwork that the taxpayer has to complete, and essentially opening up the financial kimono and revealing to the IRS all of the assets that the taxpayer has, any property, tangible or intangible, income that the taxpayer earns. These are all things that the IRS weighs in determining whether the taxpayer's proposal for the installment agreement is reasonable. Although revenue officers are instructed to request immediate payment of an outstanding liability, it's going to be obvious in most cases to the IRS when a taxpayer is unable to comply with a request for immediate payment. And so there are deferred payments and there are formal installment agreements. So let's first discuss deferred payments. As an alternative to enforced collection action, the IRS may be willing to defer payment. The revenue officer can grant an extension of time to pay for up to 120 days without supervisor approval if the taxpayer needs additional time to access funds. So essentially what happens here is the taxpayer receives a bill, and the taxpayer looks at that bill and knows right away that there's no way that he or she can pay the bill by the due date. And so the taxpayer contacts the revenue officer and requests an extension of time to pay. The revenue officer in that case can grant the taxpayer an extension to pay for up to 120 days without supervisor approval. Okay, and typically the reason that the taxpayer gives is because they need additional time to access funds. In some cases, the funds need to be liquidated. They could be in the form of a 401k. They could be in the form of a retirement plan. They could be in a mutual fund. And so the revenue officers typically are understanding of situations like that where the taxpayer needs some time to liquidate assets in order to pay the tax bill. Other times, however, the taxpayer regardless of whether they liquidate their assets, they aren't going to have the full amount to pay the tax bill. Alternatively, there are no assets to liquidate in the first place, and so the taxpayer may opt in those cases for an offering compromise. An offering compromise differs from an installment agreement in the sense that the taxpayer is offering to pay a lesser amount than the total amount due on the tax bill in full consideration for the liability. So if the liability is, for example, and I'm taking an arbitrary number here, say $50,000, and the taxpayer doesn't have any assets to liquidate in order to pay the tax bill, the taxpayer may look at his or her present financial situation and determine that he can pay $30,000, $20,000 less than the full amount, and the taxpayer may submit a formal request for an offering compromise to get the IRS to compromise the debt from $50,000 to $30,000 in full consideration for the liability. So if it's accepted by the IRS, then that $30,000 will fully satisfy the liability. Here, with an installment agreement, the taxpayer is essentially agreeing that this is the amount that he or she has to pay, and that he or she is willing to pay that full amount. However, they need to be placed on a payment plan that stretches over the course of several years in order to pay it in full. Now, with the deferred payment, as we just talked about, this is an alternative to enforced collection action. It's where the taxpayer gets the bill and sees that it's $50,000, has the ability to pay that full amount, but has to liquidate some assets or access some funds, and in doing so needs some additional time. And in this case, the taxpayer contacts the revenue officer, and the revenue officer can grant an extension of time to pay for up to 120 days without supervisor approval. Now, for formal installment agreements, these are intended for taxpayers who have serious liquidity problems, and essentially they're not liquid. They don't have the financial wherewithal to pay the full amount in one lump sum, even with an extension of 120 days. Payments under a formal installment agreement ordinarily include an interest charge computed on the unpaid balance. So to the extent that the taxpayer is successful in proposing an installment agreement and the payments are stretched out over time so that the taxpayer pays a certain amount every month, that's good for the taxpayer. However, the taxpayer is going to be paying interest on the principal. And as we all know, interest can sometimes be even worse than any penalties themselves. So that's something that we as tax preparers and tax professionals have to caution our clients about, that over the course of the installment agreement, the interest charges can be compounded and can drive the liability into the stratosphere. So what happens if the IRS rejects a proposed installment agreement? The taxpayer has 30 days in which to file an administrative appeal with the IRS Appeals Division. So as you can see here, the taxpayer does have due process rights. Taxpayers can appeal the rejection of a proposed installment agreement as part of a collection due process hearing. How about levy action? Is levy action suspended by law if an installment agreement is rejected or terminated? It is suspended by law if the installment agreement is rejected or terminated, so long as the taxpayer appeals that rejection or termination within 30 days of notification of the rejection. So I realize that that's a mouthful, but it all can be consolidated into this one rule that states levy action is suspended by law if a rejected or terminated installment agreement is appealed by the taxpayer within 30 days of notification of rejection. If the taxpayer waits until the 31st day after notification of rejection, it is too late to appeal. So essentially, the doors to the IRS appeals section are slammed shut in the taxpayer's face in cases where the taxpayer is late. So the deadlines here are critical to adhere to, because if they are not, then the taxpayer loses all due process rights to appeal the rejection or termination of the installment agreement. Application process. It begins with the taxpayer submitting Form 9466, which is called the installment agreement request. The IRS is authorized to collect a small fee for entering the agreement and for modifying it. So basically, the taxpayer would submit the processing fee with Form 9466. Now, if the IRS accepts the installment agreement, it would charge the taxpayer a processing fee. So it appears as though the taxpayer can submit Form 9466 without the accompanying process fee. However, if the IRS accepts the installment agreement, then there is a processing fee that the IRS charges a taxpayer. It's $105 for a basic agreement and $45 for restructuring of an existing agreement. And that actually brings up a good point. An installment agreement can be restructured. So an existing installment agreement from, say 2 years ago can be restructured or amended in order to reflect the current state of the taxpayer's financial affairs. So as we all know, things change over time. The taxpayer perhaps may have lost a job since the time that he memorialized an installment agreement with the IRS, and as a result cannot keep up with the monthly payments. And so what the taxpayer may opt to do is restructure the existing agreement so that he or she has lower monthly payments and is not put below the poverty line, or not put in a situation where the taxpayer is unable to pay his rent and his living expenses. And so there is a time and place for restructuring of an existing agreement. Installment agreements need not provide for the full amount of the accrued taxes, penalties, and interest. So in that sense, they do bear some of the attributes of an offer in compromise. So if you remember going back, I stated that an offer in compromise is usually a request by the taxpayer or a proposal on the behalf of the taxpayer to settle a tax debt for less than the amount, less than the total amount. And in the example I gave earlier, it was $50,000 tax liability, and the taxpayer proposed $30,000. Installment agreements typically include the full amount, but the taxpayer is requesting a payment plan. However, there are circumstances where the taxpayer will still submit a request for an installment agreement and still request that it be for less than the full amount of the taxes, penalties, and interest due. And so, for example, it might be $50,000 tax debt, and the taxpayer, can comfortably do $40,000. And so the taxpayer may request that $40,000 be extended over the course of a period of time, and whereby he pays monthly payments. And so in that sense, the installment agreement bears similarities to the offer in compromise because the taxpayer is requesting that there be an offset of $10,000. So during the period that an installment agreement request is pending, the IRS cannot levy on the taxpayer's property. So that's very, very important to realize here. It's pretty much a hands-off policy. When that installment agreement request is pending and being reviewed by the IRS cannot take any levy action on the taxpayer's property. It cannot seize the taxpayer's property while it's reviewing the request. Automatic acceptance. There are two situations where automatic acceptance can be triggered. The first is with a statutory or guaranteed agreement. The second is with streamlined agreements and the Fresh Start program. So let's begin with statutory or guaranteed agreements. In limited circumstances, the code requires the IRS to accept an individual taxpayer's installment agreement request. For statutory agreements, no collection information statement needs to be completed. The IRS must accept the agreement if the unpaid amount is less than $10,000, exclusive of interest and penalties. Within the last 5 years, the taxpayer has filed all required income tax returns and paid any tax shown on those returns. The taxpayer agrees to pay the outstanding liability in full within 3 years, and the taxpayer agrees to comply with the tax laws in the agreement while the agreement is in effect. So these are the threshold requirements that the taxpayer has to meet before which the IRS must accept the agreement. So long as the taxpayer satisfies all 4 of these conditions, there are no further questions asked. The IRS must accept the agreement. Again, the unpaid amount is less than 10 grand. Within the last 5 years, the taxpayer is in full compliance with having filed all required income returns and paying any tax shown on those returns. Third, the taxpayer has agreed to pay the outstanding liability in full within 3 years, not 4, not 5, not 6, but 3. And finally, the taxpayer agrees to comply with the tax laws and the agreement while it is in effect. Streamlined agreements and the Fresh Start program. The IRS also has a streamlined applications process that results in automatic acceptance. Again, no questions asked so long as certain conditions are satisfied by the taxpayer. The Fresh Start program provides more taxpayers with the opportunity to use streamlined installment agreements to catch up on back taxes. In that sense, it's kind of a windfall for both the IRS and the taxpayer, in the sense that the taxpayer is going to be given a little bit of leniency in terms of not having to fill out and submit all of the paperwork that he otherwise would. And from the IRS's perspective, they are able to collect as much as they possibly can within the, they're able to collect as much as they possibly can without trying to draw blood from a stone. The purpose is to help individual taxpayers and businesses pay back taxes more easily and with less burden. So long as a taxpayer meets his obligations under the agreement, the IRS won't file liens or take other collection action. And so that basically helps to put the taxpayer's mind at ease and, assists in the objective or the purpose of voluntary compliance with paying an IRS tax debt. Effective March 2012, the threshold for using an installment agreement without having to submit a financial statement, and that's the operative phrase, without having to submit a financial statement, it was raised from $25,000 to $50,000. So before the March 2012, before March of 2012, the taxpayer would have to, the taxpayer was only allowed to do a streamlined installment agreement if the tax debt was $25,000 or less. On or about March of 2012, the IRS raised the threshold for allowing the taxpayer to be eligible for the streamlined installment agreement without the need of filing a financial statement. And what they did was they raised the threshold amount from $25,000 to $50,000. Taxpayers who owe up to $50,000 in back taxes may now enter into a streamlined agreement with the IRS that stretches the payment out over a series of months or years. The maximum term for streamlined installment agreements has also been raised to 72 months from the previous 60-month maximum. So there was a maximum term for streamlined installment agreements prior to March 2012 of 60 months, meaning that it couldn't go past 5 years. Any proposal that the taxpayer made for an installment agreement had to be within 5-year period. After March 2012, when the streamlined installment agreements were implicated, the maximum term for an installment agreement was raised from 60 months to 72 months. Taxpayers seeking installment agreements that go above $50,000 must still supply the IRS with a collection information statement, and that's a very intrusive financial statement that basically digs into the taxpayer's finances and essentially lifts the taxpayer up and shakes him up and down while he's upside down in order to find whatever sources of income or whatever assets or whatever property the taxpayer owns. And so it's almost like a root canal in that sense, because it can be it's very intrusive, and it requires an incredible amount of disclosure to the IRS. So a lot of times the taxpayers aren't so willing to provide all of this information because of the privacy nature, how private it is, and so they'd rather not complete a collection information statement if they don't have to. Now, in situations where the taxpayer still wants to do an installment agreement, notwithstanding the fact that the amount is over $50,000, the strategy is to do that without having to complete the collection information statement is to pay down the balance due to $50,000 or less to take advantage of the installment agreement. So say, for example, John has a $70,000 tax bill from the IRS. John needs an installment agreement. John doesn't want to have to complete a collection information statement because of how intrusive it is and because of how it's going to, of how private he is with his financial matters. So what John can do is he can pay $20,000 and get the balance down to $50,000, or he can, of course, pay even more than $20,000, but the minimum amount he'd have to pay is $20,000 because the threshold for which the taxpayer can do an installment agreement through Streamline without having to complete a collection information statement is $50,000. So if John pays $20,000, he now has reached the maximum threshold, and he will be eligible to apply for a Streamlined without having to complete this intrusive collection information statement. Now, in order to qualify for the new expanded Streamline installment agreement, taxpayers must agree to monthly direct debit payments. Conditional acceptance. Under a conditional acceptance, the taxpayer's ability to enter into an installment agreement is largely within the discretion of the IRS. The IRS will only approve such an agreement if the taxpayer is compliant with filing and payment obligations for the current year, and second, the taxpayer is truly unable to make an immediate payment in full. Taxpayers must furnish a financial statement, which is called Form 433A, describing their assets and liabilities, disclosing their bank accounts, all employment information, future income prospects. As I said, it's the modern day equivalent of a root canal. The IRS will review Form 433A to determine whether the taxpayer's assets provide a readily available source for payment. In doing that, the IRS has to determine the following things. First, the taxpayer's equity in assets and the taxpayer's ability to use those assets as collateral to borrow from third parties in order to pay the liability. So that was a mouthful. Let's go back and just dissect that. So the taxpayer's equity in assets and the taxpayer's ability to use those assets as collateral to borrow from third parties in order to pay the liability. So what they're talking about here, whenever you hear the term collateral, we're talking about situations where the taxpayer has property. Maybe it could be real property, or it could be intangible property in the form of a patent or something that the taxpayer can use as a security interest, so to speak, in order to get money, cash money lent to him or her. So again, the term collateral is basically the what secures a debt. And to the extent that the taxpayer has some type of real property, maybe even maybe besides, it doesn't have to be a home, it could be a boat, it could be a car. Intangible property could be a patent, it could be something else in the intellectual property arena that the taxpayer can put up in good faith as a way to assuage any concerns that the lender has, and as a way to get the lender to lend him or her liquid cash to pay the tax debt. And so this is what's examined by the IRS. The second thing that's examined is whether the taxpayer has any big ticket items. By big ticket items, I'm talking about airplanes, yachts that could be sold to satisfy the liability. And so that differs from collateral. Before, I'm referring to a boat that I gave in the last example as collateral. In the second area that the IRS looks at, it's whether the taxpayer's big ticket items could be outright sold to satisfy the liability. And the third thing that the IRS will look at is the taxpayer's cash flow. This is usually based on monthly income and expense information. If the taxpayer's assets don't provide a readily available source for payment, for example, the taxpayer has no equity in assets or they're not readily disposable, the IRS will collect the tax through payments based on the taxpayer's disposable income. So what this is saying here is that just because the taxpayer may own a $700,000 property in an upscale suburban area outside of New York, in say New York, or in say Schenectady, New York, or in Montclair, New Jersey, the fact that the taxpayer owns that property is not the be-all, end-all to the determination of whether the taxpayer has the money to pay. The IRS examines the property to determine whether there are liens and what the first mortgage on the property is. And after taking into consideration the first mortgage and perhaps any subsequent mortgages like a prime equity, the IRS will then look at the fair market value of the property and determine what the equity cushion in this property is. So the property could be encumbered or mortgaged to the hilt and have absolutely no equity cushion in it whatsoever. So even though the taxpayer owns an $800,000 piece of property in an upscale area or part of town, that again does not necessarily mean that the IRS is going to reject the installment agreement and force the taxpayer to sell the property. Again, the IRS, the purpose of the collection information statement and all the financial records that the IRS demands is to probe deep and determine how much equity the taxpayer has in a property like the home. And because I'm talking about the home as an example, I will say that courts are very reluctant to force the sale of a taxpayer's primary residence in order to settle a tax debt. And the reason being is because the home is considered sacrosanct, and if the taxpayer is forced to sell a home, then that could very well lead the taxpayer to becoming homeless. And if the taxpayer has kids, wife, family, that also bears on that as well. So again, courts are very reluctant to force the sale of a home even when the IRS goes into court and has shown that repeated attempts to get the taxpayer to agree to an installment agreement or some other way of paying the debt have fallen on deaf ears, or that the taxpayer has ignored those attempts. The house, again, is considered sacrosanct and is unless all efforts have failed, and it's been going on for years and years and years and years, and the taxpayer has just made no efforts at all. Will there be any efforts? Will there be any enforcement by the courts to force the sale of the home? A taxpayer's disposable income is based on information in the collection information statement. When evaluating the amount to be paid, the revenue officer has to make an objective economic judgment as to how much the IRS can collect without jeopardizing the taxpayer's ability to support his family, pay current taxes, and earn income from which to pay future installments. So what this is saying in so many words is that the IRS doesn't want to leave the taxpayer destitute, and without the ability to pay, without the ability to live and to support his family. So part of the calculus here when the IRS is evaluating the taxpayer's amount to be paid, what gets factored in here is whether this amount, or how much the IRS can reasonably collect without causing the taxpayer to lose everything except the shirt off his back, because obviously that would set the taxpayer up for failure in the sense that the taxpayer wouldn't be able to support his family, pay mortgage, pay rent, pay current taxes, and continue to provide for future installments in going forward in the future. The idea is to give the taxpayer a minimum fair living amount, subtract that amount from income, and require the taxpayer to pay the balance in installments. So it's really not it's really not mind-numbing here. It's pretty straightforward. Again, the idea is to give the taxpayer a minimum fair living amount, so we don't force him into a situation where he's, homeless, living on the streets. We want the taxpayer to have a fair minimum living amount, and then we subtract that amount from the income that the taxpayer is currently earning. And the difference between those two figures, the fair living amount and the amount that the taxpayer is earning, is basically the balance in installments that the taxpayer has to make. So let's hone in on living expenses. In allowing living expenses, the revenue officer is generally constrained by national and local standards for reasonable amounts of living expenses. So this is not an arbitrary calculation that the IRS indulges in when they look at living expenses and they hammer down a concrete number. They are guided by and constrained, which is an even stronger term, by national and local standards for reasonable amounts of living expenses. So, for example, the local standards for reasonable amounts of living expenses are going to vary drastically between New York, for example, New York City, for example, and an area such as Nebraska, Omaha, Nebraska, or somewhere in Kansas. Obviously, as we all know, housing, food, entertainment in New York City is staggeringly higher than housing, food, entertainment in Omaha, Nebraska, or Kearney, Nebraska. Okay, and at the same time, special circumstances may cause the IRS to deviate from the standards. What are special circumstances? One example might be medical needs. Suppose that the taxpayer has a long-term illness and it's being treated by specific medication that is quite costly, and this in some way has interfered with the taxpayer's enjoyment of life. That is going to be a factor that gets weighed in this calculus as well. So that's what is meant by special circumstances may cause the IRS to deviate from the standards. If the revenue officer approves an installment agreement, he or she will insist on an immediate payment of part of the outstanding liability, followed by equal monthly payments. So it does, if it's accepted, the officer again will insist on an immediate payment of part of the outstanding liability. And by that, it doesn't necessarily mean just the first monthly payment. The immediate payment that is being referred to here could, quite frankly, be 1/3 of the full amount of the installment that's been approved. So that's something that you have to prepare your client for. And then, of course, that's followed by equal monthly payments. If the taxpayer can show an urgent need for assets and net cash flow, the IRS may allow him to keep all or some of it. The taxpayer has to convince the IRS of two things. First, that it would be unfair or inequitable to grab the asset now, or that the IRS will be better off if the taxpayer is allowed to retain more of the assets or cash flow than the national standards indicate. So one example that comes to mind in this factor that says that the IRS will be better off if the taxpayer is allowed to retain more of the assets. Suppose that the taxpayer is holding on to a stock, and that the stock is, the stock is going up in value, and the prospectus shows that the stock is going to double in value, or that there's going to be a dividend distribution in the not too distant future. The taxpayer might be able to make a substantive argument to the IRS to hold off on collection of the amount from the sale of that stock until the stock split or until the dividend distribution is issued, because of the prospectus that shows that the stock is going to increase in value over the next couple of months. So that's where the taxpayer might have a strong argument to get the taxpayer to wait until a later date and allow him or her to retain that stock until there's been the split. If the installment payments are to continue for more than 12 months, the IRS can insist that the taxpayer provide follow-up financial information, and the IRS can use to modify or terminate the installment agreement in the event that there is a significant change in the taxpayer's financial condition. So it's important to tell the client up front that if the installment payments are going to continue for more than a year, that there's a possibility that the IRS may request follow-up financial information, and that based on that follow-up financial information, the IRS might modify or terminate the installment agreement if they detect that there's been a significant change in the taxpayer's financial condition. So, for example, maybe the taxpayer gets a better job, and maybe the taxpayer's income increases significantly from what it was at the time that the initial installment agreement was memorialized. In that case, the taxpayer the IRS may demand that there be a modification to the existing installment agreement to reflect the taxpayer's higher paying job. And so this happens, this review of the installment agreement and potential modification of the terms is fair play if the installment agreement continues for more than 12 months. The IRS can modify or terminate the agreement if, and there are three conditions here, if first, the taxpayer provides inaccurate or incomplete information with the request, second, accrues additional tax liability, or third, fails to make scheduled installment payments. So those are generally the conditions that will trigger a modification or termination of the agreement. Partial payment installment agreements. These are used to reduce or settle a taxpayer's final liability. However, it does not have the finality associated with an offer in compromise. Instead, it's merely an agreement that allows the taxpayer to pay part of the liability over time. So what is the effect of the installment agreement on collection activity? The statute of limitations for collection is suspended during the period that the proposed installment agreement is pending with the IRS. Another word that we use is tolled, and that means that the clock is not ticking against the IRS to collect the amount due. And so there's kind of like a grace period, and where the clock it stops ticking, and that the IRS doesn't have to worry about the statute of limitations expiring and being unable to collect whatever amount is due. And so it's very important to advise the client, because the client oftentimes thinks that the clock is ticking all the while that the proposed installment agreement is pending, but it's actually suspended during the period that the installment agreement is being reviewed by the IRS. If the IRS rejects a proposed agreement, the statute of limitations period for collection remains suspended for 30 days following the rejection. And that's because, if you recall, the taxpayer has 30 days from the date of notification, or rather receipt of the rejection, to file an appeal. And so the IRS isn't going to trample on the taxpayer's right to appeal by trying something shady and by trying something shady in the sense of levying on any property. At the same time, the statute of limitations period for collection continues to remain suspended during that period. So it's kind of like a double-edged sword in the sense that if the taxpayer appeals the denial of the proposed installment agreement, the statute of limitations period is continued or is tolled for that period or remains suspended. Now, if the taxpayer defaults on an installment agreement and the IRS terminates it, the statute of limitations for collection is tolled for 30 days following termination. If the taxpayer appeals a rejection or termination, the statute of limitations period is suspended while the appeal is pending. So, not only is the statute of limitations for collection suspended for 30 days following the rejection to allow the taxpayer to exercise his right to appeal, but if the taxpayer does in fact appeal the rejection of the proposed installment agreement, the statute of limitations period for collection is suspended while the appeal is pending. And this is what I was talking about before. The IRS is prohibited from levying on the taxpayer's property during the following periods. Any period that an installment agreement is pending or actually in effect. So the IRS cannot try anything underhanded, such as levying on the taxpayer's property while the installment agreement is pending or is in full effect. It's also prohibited from levying on the taxpayer's property during the 30-day period after the IRS rejects the installment agreement request. And that's so as to allow the taxpayer to exercise his due process rights to appeal the denial of the installment agreement. The IRS is also prohibited from levying on the taxpayer's property during the 30-day period following termination of the agreement. So the difference, of course, between rejection and termination is that the proposed installment agreement is outright rejected, so we never even get off the ground with the installment agreement in the first place because it's outright rejected. Termination means that the IRS has accepted the installment agreement and it's in full force, but the taxpayer winds up violating the terms and conditions of the installment agreement, which causes the IRS to terminate the agreement. So for 30 days following termination of the agreement, the IRS is still prohibited from levying on the taxpayer's property. And the IRS is prohibited from levying on the taxpayer's property during the appeal of either a termination or rejection. So that's critical to understand. The 30-day period whereby the IRS is prohibited from levying on the taxpayer's property kicks in if the IRS rejects the initial installment agreement, meaning we never get off the ground in the first place, or 30 days following termination of the agreement, meaning that the taxpayer is delinquent in complying with the terms and conditions of the installment agreement. The IRS terminates it. For 30 days following termination of the installment agreement, the IRS cannot levy on the taxpayer's property, and the IRS is prohibited from levying on the taxpayer's property during the pendency of an appeal. And that appeal could be either from the termination of an existing installment agreement or from the rejection of a proposed installment agreement. But while the appeal is pending, regardless of whether it's from the termination of an installment agreement or the rejection of a proposed installment agreement, the IRS is prohibited from levying on the taxpayer's property. If you have any questions concerning anything that was covered in this webinar, feel free to reach out for me at any one of the email addresses or telephone numbers you see on the screen. You can always connect with me online through LinkedIn. If you find that easier, feel free to send me an email. My door is always open, and